Okay, the YouTube is up, and I'm going to come back to the webinar. Yeah, YouTube is up, and we'll be recording this. And I'm going to kill the, whoops, hang on. Let me do this. YouTube. I have to kill the tab, otherwise you'll get an echo. There we go. All right. And I'm going to start the webinar it's 11:59, and I'm going to give people 2 minutes to log in, and we'll cue you guys at 12:02. Is that okay?
Great.
Okay.
Good afternoon, everybody. This is SCORE Cleveland. This webinar is Basic Finances for Your Business. We'll be starting the webinar officially in about 2 minutes. Want to give people a chance to log in. So if you just logged in, please be patient for a minute or two, and we will get you going right away. Again, if you're just logging in, we're going to start in about 1 minute. Good afternoon, everybody. This is SCORE Cleveland. This is a webinar, Basic Finances for Your Business. We're starting the webinar now. The webinar is being recorded, and you'll be able to retrieve it from the SCORE Cleveland website probably early next week. Takes a day or two for it to get edited. The presenters, Richard Brooks and John Heston, will introduce SCORE and themselves, and we are starting now.
Dan, thank you very much, and welcome everybody. I see a lot of people are signing in the chat box. Greetings to all of you. Richard and I are both volunteers with SCORE Cleveland, and we're going to be giving the presentation today. And it's going to be a accounting and finance for laymen. We're not MBAs or anything like that, but we're just common sense, the basic concepts, and how to use financial data to improve your profitability. Richard, go ahead and go to the next slide, please. We're going to begin with talking just a little bit about SCORE. And SCORE is a national nonprofit organization. It was founded back in 1964, a couple of years after President Kennedy challenged us to ask what we can do for our country. And around the time that the Peace Corps and VISTA started, a little later, SCORE started. gave people with business experience a chance to volunteer and give back to their communities. And that's what we do in SCORE here. Next slide, please. Most organizations have a mission, vision, and values, and SCORE's mission and vision are all about supporting small business, and that's all we do. We're here to give people the support they need at any stage of business. Next slide, please. So our services are primarily mentoring. We do a lot of that. Our mentoring methodology consists of first listening to people, clients, finding out where they are in the journey, where they would like to go, and kind of how far they are down on the journey. And we work with them. We listen and provide resources where we can find them, recommendations, and help people to tread their own path, but we try to make sure that they got support every step of the way. Before the pandemic, we did most of our mentoring in person, but now we're using remote methods, email, phone, telephone, and lots of video mentoring, which works pretty well because we can share our screens and show clients resources on the web. The other thing we do that's not as common as mentoring is workshops and seminars like this one. And so if you've signed up for this one, you've probably seen a lot of the other offerings that SCORE has. We have other services. For instance, small businesses can ask for SCORE mentors to join a board of advisors for their business to kind of have a regular input from somebody independent on business decisions. We also have, if you go to score.org, which is the link down in the lower left corner of this screen, you can also find a wonderful library. And if you go in there and across the top, there's some tabs. And if you click on the templates and resources tab, and not the drop down menu under it, but the actual tab, you'll get basically a library that has hundreds of articles and templates and various blogs and things like that on just about any business subject you can think of. And you can have the filters where you can downsize those hundreds of them down to just a few of the ones you really like. So there are lots of things SCORE does, and it's what we do volunteer. Next slide, please. Our services are free. Our parent organization is the U.S. Small Business Administration. We also get supported by grants from other organizations, other nonprofits, and so the infrastructure is paid for by SBA and various sponsors, and plus our network of around 100,000 volunteers are unpaid volunteers. So that's why we can provide professional services at no charge to you. Next slide, please. This is a copy of the SCORE Cleveland website. It looks very much like the national one, has a lot of the same resources. And this is where you go along with the national site. And then if you can see in the upper left corner where it says Find a Mentor on the toolbar, that's where you can click and you can see profiles of every mentor on SCORE Cleveland. Plus you can go through fill out the form to request a mentor by either geographic location or by the kind of subject matter that you want. One of the things that we do, we have an initiative called One SCORE, which means whoever you contact is going to take ownership of that relationship. And if they're not the right person, they're going to find among those 10,000 mentors, find you the best match and a warm handoff to somebody who can give you the precise help that you need. And we'll go on to the next slide. And at this point, I'm going to turn the presentation over to Richard Brooks. I'll be giving some more of the slide later on. Richard, over to you.
Thank you, John. As you can see on the slide, at this point, we're going to start talking about how to make more money in your business. But in order to do that, we're going to have to develop a basic financial vocabulary. So we're going to spend a couple slides talking about the basic financial vocabularies to make sure that everybody has a common understanding of what we're going to present to you. Okay, so in today's session, you'll learn some financial vocabulary, how to calculate profitability, and how to calculate your break-even point, types of accounting, because there are actually different kinds of accounting, and John's going to go into that. what financial statements look like, and then a little bit about financial service providers. Okay, so what we're going to do is we're going to start out by tracking your money coming into the business and your money going out of the business. And the money coming in is your revenue. And there'll be a couple slides on this. Along with money going out are your expenses. So your revenue is money coming in. And that is primarily from sales. It's not entirely from sales. And I'm going to give you a couple examples of that in a few moments. But when we say money or when we say revenue, what we're saying is that you've provided a product or a service and you've been paid for it. And the form of payment can be cash, it can be credit card, it can be check. But that's revenue in whatever form it happens to come in. And then we have our expenses. And our expenses are what you spend in your business to pay for what you need to operate the business. So it can be raw materials. If you're doing products, it can be cleaning supplies. It can be paper and stationery. It can be payroll. For you, it can be marketing. It can be your website. There are all kinds of different expenses that you have. And we're going to go into that in a little bit more detail. So if you take all the money that you have coming in, and then you subtract out all the money that you have going out, that will determine your profit or your loss for any given time that you're measuring your business financially. Okay, let's move on. So sales, revenue, money coming in. And you notice here at the bottom, it says sales and revenue are not exactly the same. And that's really important. Let me explain why. Let's say that somebody comes to you and you're selling widgets and they order 100 widgets, but you don't have 100 widgets in stock. And so they sign a sales agreement to buy 100 widgets from you, but the 100 widgets will be delivered in 3 weeks once you get your stock up to date. Okay, you can record the sales, but if they haven't paid you in advance for the widgets and you haven't delivered the widgets, you cannot record the revenue. So they're slightly different concepts. In most cases, when you deliver a product or a service, you will probably get paid right at that time. Another example might be accounts receivable, where somebody orders a product from you and you give them 30 days of credit before they have to pay. Well, that would be accounts receivable. And so you can book the sales, but you can't show the revenue because you haven't actually received the money coming in yet. So that's an important concept to keep in mind, okay? Costs are money going out. And it's a similar kind of a concept to the revenue coming in. By this, I mean, if you buy something from somebody to resell or to use yourself, and they give you 15 days to pay or 30 days to pay, and you don't pay right when you receive the product, you pay 15 days later or 30 days later, then you record your expense at the time you've actually paid, not at the time that you've incurred the expense. So slightly different concepts. It's important to understand where it all fits into the puzzle. Okay, so let's talk about your business. Sales and revenue, money coming in, costs, expenses, money going out. That's the basic foundation that we're going to start with. So let's talk about expenses. There are really two types of expenses. First, there are fixed expenses, and next, there are variable expenses. Let's still dig in a little bit more to each type of expense. Okay, So we're talking about fixed and variable expenses. Fixed expenses are expenses that stay relatively the same regardless of sales. And I'm going to show you some examples of fixed expenses and variable expenses in just a moment. Variable expenses are expenses that increase as sales increase. Okay, so fixed expenses doesn't matter whether you have no sales or 100 sales, they remain relatively the same. There may be some variance. For example, if you're doing manufacturing and you have a big load of a number of orders that come in all at one time, and you have to gear up your manufacturing facility, yeah, your electricity bill or your gas bill may be a little bit higher than it is on average. But in general, fixed expenses stay the same. Variable expenses increase as sales increase. Let's talk about some examples of fixed expenses. Your utilities, water, gas, electric, those generally are pretty much the same every month. Rent should not vary very much from month to month. You're renting a facility and it doesn't really change. Your loans for equipment and your auto loan, they won't change very much. Your insurance for your business, that's the same every month, or maybe you pay it quarterly or yearly, but your insurance is fixed. Salaries for your salaried employees. Now, it's important to distinguish salaries for leaders of your organization and hourly wages for the people that work for you if they are on hourly wages. And I want to make sure that this is clear. If you're the CEO of your own company and you're drawing a salary, that salary does not specifically relate to the production, whether it's a product or a service of your company. So you're drawing a salary, whether you have one sale for the month or 100 sales for the month. It's not directly related to the production of your company. So that's why your salaries are considered fixed, because from month to month, they don't change. Examples of variable costs would be commissions. You have a salesperson working for you, and that salesperson earns their living by providing sales, by selling your product or service to your customers. Another example would be raw materials. If you aren't buying a lot of raw materials to produce products for your business, then your variable cost is going to be low. But if you're buying a lot of materials, those materials are directly related to the amount of sales that you're doing, and therefore it's a variable cost. Shipping costs. If you're not shipping anything out, you have no shipping costs. But if you have 100 widgets and you're selling those widgets and each one is going to a different customer, you have increased variable shipping costs. Direct labor. Direct labor is labor that is directly related to the production of your product or your service. So an example is, let's say that you have a seasonal business, and because it's a seasonal business, you have 5 people working for you during the peak season, but you only have 2 people working for you during the off season. And so your hourly labor is directly related to the amount of production, whether it's a product or a service, that your business actually sells. And so during the off season, your variable cost is going to be lower because you're selling less. During your peak season, your variable cost is going to be higher because you're actually producing more, and therefore your people are working longer hours. You have more people on your staff, and it's a variable cost. Your marketing can also be a variable cost. You may have a marketing campaign in January, February, and March, and then back off in May, June, and July. Marketing is another good example of a variable cost. So let's see how this all works. We've created a fictitious company called Puzzle Mania, and they produce puzzles. So what we're going to do is we're going to examine their fixed costs, their variable costs, and kind of how this whole thing comes together. So first, let's look at their fixed costs. They have rent for $3,000 a month, telephone for $100 a month, insurance for $300 a month, salaries for the 1, 2, or 3 people that work at Puzzle Mania that are not directly involved in production. Okay, those salaries are $5,000 a month. Their internet services, $120 a month. Their utilities are $550 a month. And so their total fixed expenses each month amount to $9,070. Now, that's their expense side. Let's look at that was their fixed expense side. Let's look at their variable expenses. Their variable expenses are raw materials, wages, credit card fees, shipping, and marketing. But notice that we express their variable expenses as a percentage, not as a dollar amount. And the reason why is they're directly related to the amount of business the company is doing. So if the company has done this properly, their raw material expense will be 15% of sales, no matter whether they sell 5 units or 50 units. In this case, puzzles. Their wages are 20%, and they will know what their wages are because they know what they're paying their people on an hourly basis. And that's all based on production, how many people they have and how long those people work. So they know that the wages that they're paying their staff, their production staff, is 20% of sales. Their credit card fees are, again, directly related to sales. And credit card fees generally range from 2.25% to about 3.5%, depending on what credit cards you're using. American Express tends to be a little bit more expensive. Visa, MasterCard are right in the middle. There may be some that are a little bit less expensive as well. So the credit card fees are 3% of sales because they know what to expect on that. Shipping is about 3% of sales because they know what to expect on that. And their marketing expense is going to be 8%. And the reason why they know that is they set up a marketing budget based on sales. And they know that it's going to be about 8% of their total sales. So their fixed expenses are expressed as dollars, and their variable expenses are expressed as a percentage of sales because the variable expenses are not the same every month. So in this case, variable expenses are 49% of sales. So if you look at the lower left screen now, Puzzle Mania sells 1,500 puzzles at $20 per puzzle in October. So if they sell 1,500 times 20, their revenue is $30,000 for the month. Let's examine this a little bit closer then. Their revenue is $30,000. Their variable expenses are 49%. So if we take 49% of $30,000, we see that it's $14,700. Their fixed expenses, we've already seen, are $9,070. So they have a gross profit, or I'm sorry, a profit margin of $6,230. Or expressed a different way, going back to percentages, they have a profit margin of 21% of sales. So they're making 21% profit before other expenses on their total sales for the month. And remember something, and that is Uncle Sam is your partner. This 21% profit margin is before certain other expenses, the most important of which is the taxes that you have to pay, the income taxes to the federal and the state governments. Okay, moving on. So let's look at how Puzzlemania actually determines what their break-even point is. And their break-even point is the point in which their sales cover all their expenses. They haven't made a profit yet, but they haven't lost any money. And that's the break-even point. So let's dig into this a little bit more to see how this works. Okay, the sales level at which total revenues equals total expenses. And here's the formula. Fixed expenses, rent, insurance, salaries, whatever it happens to be, divided by the price per unit minus the variable cost per unit. And if you remember going back 2 slides, and I'll just slide back here real fast. That's their profit margin. See down in the lower right-hand corner, that's their profit margin. Variable expenses, the revenue minus variable expenses, fixed expenses. So, okay, so that's what we're talking about. So if you divide that margin into the fixed costs, that will show you the number of units they have to sell in order to just break even, not making a profit, not making a loss. So let's look at this a different way graphically. Okay, Puzzlemania, you can see in the graph, rent, telephone, insurance, all the other fixed expenses, $9,070. Okay, and their variable expenses are 49% of their total sales. So let's look at this using the formula that we just viewed on the previous slide. Their fixed expenses are $9,070. Their contribution margin is calculated by taking their price per unit and subtracting from that 49% of sales. So in this case, it's $20 as the price per unit, and their cost of sales, their variable cost of sales, is 49%, or in this case, $9.80. That means that if they take the $10.20, which is the contribution margin, and divide that into the $9,070, they have to sell 889 puzzles in any given month in order to just break even. So what that really says is the contribution margin must cover the fixed expenses just to break even. And think of it that way. The contribution margin has to cover the fixed expenses, and the contribution margin is what is left over after the variable expenses are already taken out. So in this case, we take the $9,070, we divide it by the $10.20 that they have left over after the variable expenses are taken out, and it's 889 puzzles. So what it's really saying is if you take the 889 puzzles and multiply it times $20, that says that they have to have revenue of $17,780 in any given month, because that's the equivalent of 889 puzzles. So graphically, our break-even point is shown here. When they reach $17,780, they are breaking even. If they earn more than $17,780, they're going to make a profit. If they take in less than $17,780, they're going to have a loss for the month. Let's move on to another example. Here's Lulu's Beauty Salon. Okay. This is a service industry, not a product industry. For her fixed expenses, Lulu has rent of $4,600, telephone of $300, insurance of $1,200 a month, salaries. It's just Lulu, and she's drawing $3,750. Internet, IT, and website, $820 a month. Utilities, water and electric, $750 a month. So Lulu has total fixed expenses of $11,420. Her variable expenses are the products that she uses. So shampoo, conditioner, hair dye, hair permanent kits, and she pays her the people that work in her salon by commission. So they don't get a salary. They earn their money based on the number of clients that they serve during the month. Lulu has credit card fees of 2% and a marketing fee of about 4% of sales. So her variable expenses are 60% of sales. If you remember, Puzzlemania was 49% of sales. So Lulu's variable expenses are a little bit higher than Puzzlemania, and her fixed expenses are higher than Puzzlemania. But let's see how this works for Lulu. So Lulu services 18 clients a day, 6 days a week. So that means she services, her salon services 108 clients a week, and there are 4.3 weeks in a month. So the monthly number and her average service, between perms and haircuts and maybe finger polish or whatever it happens to be, is $120. If you multiply 108 times 4.3, again, the number of weeks in a month, times $120, Lulu averages $55,720 revenue each month. Now let's go on to the analysis. So we have $55,728 in revenue, in sales every month. Lulu does not extend credit. So these are either cash or credit card. And so she's bringing in that amount of revenue every month. Her variable expenses are 60%. Well, if you take 60% of $55,728, it comes to $33,437. Her fixed expenses are $11,420. So Lulu is making in contribution margin in profit, not in contribution margin. She is making $10,871. That's her profit margin. Her profit margin is 20% of sales. Now, let's look at it graphically, just like we did with Puzzlemania. So Lulu's fixed expenses are $11,420. Her variable expenses are 60% of sales. So her fixed expenses, $11,420, just as we mentioned before. Her variable percentage is calculated at or contribution margin rather is calculated at $120 in revenue per client, $72 in cost. So you subtract 72 from 120, that leaves a contribution margin of $48. If we take that number that $48, and divide it into her fixed expenses, $11,420. That means Lulu, her break-even point is 238 clients every month. And that's her break-even point. She has to have 238 clients coming in the door and being serviced at an average of $120 per client in order to break even. Let's look at it a little bit differently. Okay, 238 clients at an average of $120 per client means that she has to have $28,560 in revenue just to break even. So her break-even point, as shown on the graph here, is $28,560. If she brings in more than $28,560, she'll make a profit. If she brings in less than $28,560, she will have a loss. Okay, we want to do one more example for you. And again, this is a service business, Walter's Window Washing Company. Walter's fixed expenses, he has a truck lease of $600 a month, truck insurance of $150 a month, liability insurance of $400 a month, health insurance of $1,250 a month, cell phone of $100, and a website and internet of $100. So Walter's fixed expenses are $2,600 a month. Let's look at Walter's variable expenses. Gas, and that's gas for his truck, 10% of sales, because he has a mobile business. He's not working out of an office. So he's averaging about 10% of his sales in gas for his truck. His window cleaner is only 4% of sales. He needs fresh rags and towels every month, so that's 3% of sales. Credit card fees, 3% of sales. Again, he's not extending credit to his clients. They either pay him cash, check, or credit card right off the bat. And then marketing, 4%. And the marketing would also, for example, be, attributed to he might be doing, specials and sending out flyers, those kinds of things. So total variable expenses of 24% of his sales going to variable expenses. So Walter services 2 clients a day, 4 days a week. That means that every week he's serving 8 clients times 4.3 weeks in a month, and his average cost is $300. So if you take 8 clients times 4.3 weeks in a month, 8 clients a week times $300, that means he's averaging $10,320 every month in revenue. Let's use those numbers and move forward. $10,320 in revenue. 24% of his revenue is variable expenses. We take 24% of 10,320, and it's $2,477. Subtract that out from the 10,320, and then subtract out his $2,600 in fixed expenses. That means Walter is in profit $5,243, or 51% profit margin. Let's look at it graphically now. We show his fixed expenses of $2,600. His variable expenses are 24%. So we take the $2,600 and we divide that by the contribution margin. And the contribution margin, again, is the price per unit minus the variable cost, or in this case, $300 minus $72, or $228. So we take the 228 and we divide that into 2,600. And Walter needs only 12 clients a month to break even. To show that a little bit differently, 12 clients times the $300 revenue means that his break-even point in revenue, not in number of clients, but in revenue, is $3,600. So that's what he has to make every month in order to break even. We show it here graphically. You can see the $3,600 on the left. If Walter makes more than $3,600, he'll make a profit. If Walter makes less than $3,600, he's going to have a loss. And so that's the concept in break even. Now, I'm going to turn it back over to John, who's going to talk about how to collect financial information.
Thanks, Richard. Thank you. Okay, there's a lot of sources of financial information, and as you can see on the slide, accounting software is a really good way of doing that. Most companies either hire accountants or bookkeepers or use software, and so if you're doing that, a lot of that is automatically loaded. So every time you do a transaction, whether for an expense or revenue, that automatically flows into the software. So as you can see on the revenue side, there are other sources. If you don't have the software, bank statements in the deposits, you certainly can capture your revenue off of that when money is coming in through the bank. If you got one of the point of sale systems, those systems can capture that data. If nothing else, another possible source is paper receipts. Square is another application that can do this for you. And as you can see, Venmo, Cash App, Zelle, all of these other capture your revenues. Now you've got to be careful not to duplicate. You want to capture money coming in from a bank statement and then also from a paper receipt. So whichever system you use, be consistent and make sure that it's all inclusive and mutually exclusive. Okay, Richard, on the other side, on the expense side, again, the bank statements, the debits, excuse me, from that are sources. And the checkbook, likewise. Again, pick one or the other, but make sure that they're consistent. Paper invoices, just like your paper receipts. Your vendor account history, and you might have an app, a customer interface system where you're capturing that data. If you're using credit cards and you're getting your payments through credit cards, you can use the credit card transaction record. For payroll, you may have a payroll service or again payroll software, so you can capture it from that. And if you're hiring contractors, individuals to serve as contractors, people who are not employees, but they're people whose income you capture on a 1099 form for the IRS, then make sure you capture that data as well. So those are, in general, the sources of financial information. Next slide, please. I'd like to shift gears at this point and talk a little bit about accounting. Up until now, Richard's given you a good overview of how to calculate profit and loss, given fixed and variable expenses, talked about the break-even point and how to calculate that. We're going to talk a little bit now about how you can use that data, what that data does for you, and how you can use it to improve your profitability. So first of all, there are two kinds of accounting. It's all the same accounting. The formats and everything are the same, but these two categories capture the purpose of it. So financial accounting is recording past transactions. Managerial accounting is forecasting your future performance. So you're using the same format, you're using the same kinds of reports, but you're using it for different purposes. And just by way of example, if you start a new business from scratch, you've never done this before, you won't have any past records. So you're going to have to make forecasts based on your own research into the industry and basically educated guesses. You don't know, you haven't done this before. You can try to find out information on similar businesses. The Census Bureau has some limited data you can use. There are a lot of sources when you're doing your market research. You'll be doing this. But managerial accounting, if you're starting your business from scratch and you have no history, it's an educated guess. In fact, that's the difference between these two. So in financial recording, again, this looking at the past transactions, they're very strict formats, very strict conventions, has to be done very precisely. Managerial accounting, again, looking ahead, trying to drive with headlights on in the dark. You're using the same formats, but you're not worried so much about the conventions because nobody knows what the date is. If you don't have a working crystal ball, you're making the best guess as you can. But it's got to be consistent with your financial data. So the past and the future need to be consistent, especially once you start generating some history, some actual numbers. And financial data, because it's used to prepare your taxes and to generate documents that stakeholders might look at, it's got to be very precise. It has to withstand audit. So an auditor should be able to go in and every transaction they see that's registered, logged in from the past, needs to accurately reflect transaction, the source documents for the transaction. Managerial accounting, again, you're looking into the future, and it just has to be realistic. Nobody has a working crystal ball, so it's got to be something that a reasonable person would say, yes, in this line of business, that looks like a pretty realistic number. You'll never know the exact number, but the more history you get, the more precise you're going to get. Financial accounting is usually done by an accountant or other provider or by software. If you're doing managerial accounting, you might get support from an accountant, bookkeeper, or other provider, but the person making the forecast has to be the business owner because that's the person who knows where they plan the business to go, what markets they're going to pursue, the conditions in the overall industry. So basically, they're the same tools, but they're used for two different purposes, and it really helps if your projections and your actual data are integrated, that they're comparable to one another going forward. Next slide, please. Okay. Next slide, Richard. Okay, so another way of looking at this, the financial data produces information mostly for others. You use it too, but again, it's produced by accountants, bookkeepers, or software, and it provides valuable history to stakeholders and the IRS and the state tax authorities. Managerial accounting is mostly for you. And what you're doing with that, you're building a financial model of the company. As you go along, you get better data. So the forecasts do start out very rough. As you get actual data, they get better. They never get precise because markets change. Unexpected things happen, both good and bad. But you get closer, and you've got at least a reasonable guess as to what's coming up in the future that you can plan for. And for managerial accounting, you can use spreadsheets, graphs, or paper. You're pretty flexible because you're looking into the future. Use whatever works for you. So for the rest of our presentation, we're going to be focusing mostly on managerial accounting because that's what you use. You use past records, but you're really looking to the future to forecast how healthy your business is going to be and how to improve your profits. Next slide, please. Accounting systems generate three basic financial reports. And what Richard's talked about earlier, profit and loss, it's basically a profit and loss, sometimes called an income statement. And that's kind of the classic statement. Each of these kind of reports together, they look at similar data from different vantage points, but together they give you a pretty nuanced picture of your business. So profit and loss is one of the three statements. The next one is cash flow. We'll talk about this more in detail on another slide. However, it's basically taking that same revenue and cost data, and it's presenting it in a way that helps you get a future view of what your checkbook's going to look like in future months. And there's a third financial statement. It's not going to be subject to our presentation today. It's a balance sheet. If you've ever done a household net worth statement where you have all your assets on one side, your liabilities on another, and it's either a positive or a negative number, a business balance sheet is a little different because it's got the assets on one side, it's got liabilities. That one category of it is debts, and the other category of it is equity. And basically, it helps capture when you subtract the liabilities from the assets, whatever is left is your equity in the company. And we're not going to discuss that. We're trying to keep it simple. But if you need to get into that, there are some a lot of good accounting courses out there where you can get those details as well. But these financial statements help you prepare your taxes. And also, if you're going to a lender or potential investor, they're going to want to see both your past data, if you have any. If not, they're going to be looking very closely at your projections to try and guess whether or not your company is worth investing in or lending to. So also it helps you predict the future of your business, again, by creating that financial model we mentioned earlier. And once you've got the model, you can tweak the model and find ways to improve your profitability. They also help you gauge the health of your business, not just financially, but overall, the health of your processes, the quality of your products, customer satisfaction. It can be part of a dashboard that you can use to help manage your business to look into the future. Next slide, please. So again, financial accounting. Did we go back instead of forward? There we go. Okay. Profit and loss statements or income statements. Again, here you use data on your revenues and costs, just as Richard explained, to determine current profitability. That's financial accounting. If you're also going to use it to look into the future, how profitable your business is likely to be over time, that's managerial accounting. If you're preparing your taxes, the profit and loss statement is where that data is going to come from. That's financial accounting again. That's looking to the past, recording past transactions, and doing something very specific with them. Demonstrating to potential stakeholders that you have a realistic path to profitability. And there, if you're going to an investor or a lender, or if you're going to collaborate with another company, do a partnership, a strategic partnership, they'll want to see both your past record and your realistic projections. Likewise, and here's where we get into improving your profit. You can use your income statement to pinpoint any excessive costs that maybe you can avoid, or unprofitable product lines, and you can look for how you can get the best profit for what you put into the business. So that's what you do with what the profit and loss statement can do for you. Next slide, please. The cash flow statement, as we said, uses both income and cost data. And what it'll do for you, help you predict and prepare for cash shortages. So cash flow crunches, and many of you may have already experienced this, can sink a business faster than lack of profitability. If you reach a point where you can't meet payroll or can't buy raw materials, even before you show up as unprofitable, it could sink you. So it's very important to pay attention to cash flow. And so a cash flow model can help you feel what your checkbook's going to look like in the months ahead. And this is almost all managerial accounting. You've got to accurately capture the past. Once the past is done, other than use it as a basis for more projections, you're really in the territory of managerial accounting. So if you want to make a major purchase, you want to buy a vehicle or some new capital equipment, by looking ahead, you can see when you're going to have the cash to do that, and you can plan accordingly. Every business ought to have some sort of cash reserve, and you want to have enough to meet the crunches, the low times, especially if you've got a cyclical business where it's seasonal. You want to have some kind of a reserve to get you through the lean part of the season. However, if you carry too much cash, and while interest rates are coming up now, savings interest used to be really low, and so you're actually losing out to inflation if you carry too large a reserve. So you want to predict the right kind of reserve for your business and your marketplace. Then you can use cash flow models to do that. And again, if you're going to a potential lender, investor, or strategic partner, and sharing that information with them, it kind of gives them and you a realistic view of your cash resources. Next slide, please. Okay, there are various kinds of financial service providers, and people throw these around, and sometimes you need to stop and see what each of them can do for you. So a bookkeeper usually has an associate degree or higher, and their specialty is actually recording financial transactions. They may be able to do more for you, but you can't count on it. You can't expect that necessarily. An accountant usually has a bachelor's degree or higher, and in addition to recording transactions, they can also interpret financial uh, information and give advice. So an accountant has that extra dimension, and they can actually be your partner in projecting into the future. A certified public accountant does everything a regular accountant can do, but they've passed an examination. They're licensed by the state. So you've got basically the same kind of specialist, but you've got somebody who has an additional credential and some credibility that can professional credibility help. So it gives you a bit of extra assurance. Next slide, please. Um, So it's important, as I said, to make sure that your past accounting of your past transactions is consistent with ongoing accounting. It's not just a one-time effort. It's like driving down a road in the dark. You need your headlights on, and sometimes you need your high beams on to see what's up ahead. So use the past. The more past data you get, the better view into the future. Knowing, recognizing, there will be surprises, changes in the marketplace. You're still better off than going with no projections at all. So if you use an accountant, show them your projections, make sure that you're consistent, and especially if you got an accountant or you got a bookkeeper that's just good at this, and you and they are happy doing this, and you're confident. Make sure that you use them as a partner, and you get everything you can, all the benefit there is in working with an accountant. If you're using accounting software, and lots of people are doing that these days, it's putting out financial reports. You need to kind of do a realism check. Make sure that what it's doing squares with your understanding of things. If you're manually tracking things, make sure your source documents add up to what the software is showing. If something looks awry, contact customer service to see if you can understand how their algorithm works. They're not going to share the algorithm with you, but if you point out a problem, they should be able to help you sort through whether it's their algorithm or maybe some misunderstanding. So whatever you do, don't just hand it off. Make sure you're a partner with whoever does the accounting, and that's one of the things we wanted to do when Richard and I were part of a team that developed this course. We didn't want to give a classic accounting course, but we wanted to make it practical for laymen. And the important takeaway is once you know the basics, engage with whoever or whatever system is doing the work, and make sure that it's going the way you want it to go, and you're getting good data to make projections. Next slide, please. Your accountant can do more for you than just that. The basis for any accounting system is a chart of accounts, and charts of accounts are pretty standardized for most industries, and usually most professional associations you can on the web. And a chart of account is just a bucket that you put your revenues and your expenses into. So that's pretty standardized. What you do have some control over how much detail you go into. When you gather data, there's a cost to that in terms of your time, sometimes some expenses if you need to buy some capability to do the calculations. And what you want to do is find the right balance between good projections that will help you make decisions for the future and the amount of money you spend on gathering and generating that data. So you want to have that broken out into the right level of detail. And that's a matter of trial and error. You need to find out what works best for you. So the more data you have, the more you can make fine decisions on what's profitable and unprofitable product lines or types of customers. But again, how finally break that out depends on how much time and money you have. Keep looking at your financial statements and reports, looking for trends and anomalies. If your forecast is very different from your actuals as they're coming along, check and see what's going on, whether it's good or bad. if something good is going on that's unexpected, sometimes you can use that and export it to other product lines or other customer groups. So analyze as much as you can, both good or bad departures from what you expect. If it's unexpected, drill down, see what the causes are, and you can identify both the most profitable product lines, customer segments, um, quality problems. And again, if you can diagnose problems and solve them before they get too bad, it's usually a good idea to have some sort of a dashboard, both financial and non-financial. Also track your customer satisfaction, your customer complaints, your quality issues, both good and bad, and that will help you control your processes and make more profit. Next slide, please. Okay, finally, we will leave you a glossary, and this is when you get your copy of these are the concepts that Richard explained in the first part of the presentation, so you got the definitions for that. And terminology, like anything else, if you're a layman, if you know the terminology, you can engage with professionals. You're a long way there. So that's all we've got. Let's open it up for questions. I see there's been pretty lively question and answers, so let's open it up and see if we can't address those. And Dan, I don't know if you want to open the mics or whether you want to try to summarize what's in the Q&A box. I know I'd seen some dialogue about fixed versus variable costs, and somebody I think had brought up the fact that in their business, electricity is a variable cost. So if you're doing cryptocurrency mining, you might, if it behaves like a variable cost, again, those are kind of what's ordinary, but you might be in a business that's different from that, but treat it based on how it behaves and be consistent with it. That's the other thing. Accounting systems have to be consistent. If you treat a cost one way one time, another way another time, it'll never pass audit. Anything else?
There are a couple of questions in the chat we can approach here. The first one is, will we receive a copy of the slides? As was mentioned earlier, the entire presentation will be available to you probably at the beginning of next week on our website. And anybody who registered for this, and correct me if I'm wrong on this, Dan, but anybody who registered for attendance today and for next week's, because next week's actually follows up on this one and actually gives you some strategies on what to how you can use different strategies in your business using this information, will receive copies of the PowerPoint. Am I correct on that, Dan?
Yes, you are. If you joined this webinar and you stayed with it, the system will automatically tag you to receive copies of the slides. And of course, keep in mind, as Richard just said, this is a two-part series, and the greatest benefit that you will get is to attend the second session as well.
Right. There's another question here. How do you factor in taxes? In this example, taxes are not accounted for. You notice that we, in the first example with Puzzle Mania, we said, don't forget taxes. Well, taxes are a separate classification after you determine your general profitability, because if you're not profitable, you don't pay taxes. And if you are profitable, you do pay taxes. So that generally comes in on a line that is usually titled, taxes after profit, or the profit line is sometimes called net profit before taxes. And so taxes are the last expense to be deducted from your business to determine your real bottom line, your real net profit. So that's where taxes come in. There, after all other expenses are paid, and if you have a profit, you pay taxes. If you don't have a profit, you don't pay taxes. Dan, you
I
want to
see
take
we
the
got a
next one?
yeah, I see
John?
we got a question in the Q&A block. It says, as a retail company that sells various items at various prices, how do we calculate price per unit to be able to get our break-even point? And basically what happens, if you've got just a few products, you can break them out. However, if you have a large number, you probably will break them out into categories and calculate an average. And you saw, I think, in Richard's examples for Lulu's, the average service was like $120. So yeah, if you had like various grades, you work out, accumulate the data in a way that enables you to work with it. You have enough, general categories that you'll get a realistic. Again, you're building a model to try and guess at the future.
Yeah.
There's a question here on how accounting pitfalls between product and a service. If you're thinking about product as selling items like consumer packaged goods or clothing or whatever, then you're working on inventory and your cost of goods sold. In the area of professional services, generally you're looking at billable hours. And with that regard, one of the things that's really important is to make sure that you add to your labor rate your overhead rate for your fixed costs, plus the profit margin that you want to achieve, for providing that service.
Okay, another question here is it bad to pay taxes when you do your taxes at the end of the year if you are a single member LLC that do your taxes on Schedule C of your 1040? That is really a question for your accountant. In some cases, depending on your state requirements and everything else that goes into it, sometimes you have to pay taxes quarterly. For example, sales taxes have to be paid quarterly. There may be situations where your corporate taxes have to be paid quarterly. And that's one of the reasons why you want to work with an accountant, because the accountant knows the answer to that question. Neither John nor I are accountants. We are business managers. And I've had situations where companies have had to pay taxes quarterly, and I've had situations where we didn't have to pay taxes till the end of the year. Keep in mind that if you have a loss for one quarter and a profit for the next quarter, for the first quarter, you won't have to pay taxes, but in the second quarter, you may have to pay taxes.
I see one. We have an ice cream storm and sell multiple stuff like ice cream, shaved ice, candy, etc. We buy, say, $1,000 for ice cream for a month, but didn't sell it all during a month. Is the full amount of $1,000 considered a cost for that month? And I think that goes to, and again, we're trying to keep it simple, but I think the accounting concept is accrual versus actual accounting. There's two ways of capturing that. Richard, are you more familiar with accrual type accounting?
Yeah, as John was saying, there's really two formats for accounting. One is called cash accounting, and one is called accrual. Now, in the case of cash accounting, if you buy ice cream in a given month, but you don't sell it to the next month, the fact that you paid for it in month one, it goes as an expense in month one. If on accrual accounting, you don't show on your books that you have an actual expense, even though cash has gone out the door. You don't show that you have an actual expense until you have sales to run against it. And accrual accounting can be a little bit more complicated because of that. And a lot of our businesses right now work on cash accounting because it's a much simpler approach. There are rules into what you can accrue from a revenue as well as a expense point of view, and working with your accountant to understand those rules and then set it up in your QuickBooks or FreshBooks or whatever you happen to be using is an appropriate process for you. Anything else? Dan?
No, I think we're at the a little bit over the hour limit.
Yeah. Yep.
So we are going to have to wrap this up at this time. If you would like to explore further how SCORE can help you, go to the score.org, www.score.org, and click on the Request a Mentor link. There's a small short form that you can fill out. And you can indicate your business, how you can be contacted, and what kind of help you're looking for, whether it's marketing or accounting or whatever. And then SCORE will assign a mentor to reach out to you and can provide you help. All SCORE sessions are held via video conference call. All SCORE sessions are confidential. SCORE will never share any information about your business with anyone. So your best bet for further assistance, if you liked what you heard in this webinar, is to go to the SCORE website and request a SCORE mentor and take it from there.
And don't forget to join us next week.
And one last time, score.org. This time next week, there will be a recording of this session on there. So with that, ladies and gentlemen, and our presenters, thank you, John. Thank you for everything that you guys have done. Richard, thank you for everything you have done. Thank you, audience. There were 167 of you on the call today, so we're sorry we couldn't get to all of your questions. But please come back next week for the next session, and we're going to end the session